Joining us now to talk a little bit more about this is Kathryn Rooney Vera, Chief Market Strategist at StoneX Group, helping us count you down to the closing bells with just 10 minutes to go. And Kathryn, I think it's fair to say this is a market on edge right now. What, if anything, would settle it down?
Well, the only thing that I think can settle it down, Romaine, is when Lloyd starts to, ensure tanker crossings at a normal rate. That's a security issue, and that's not going to change for the foreseeable future. But that's, I think, ultimately what changes the story. But right now, I think the markets are beginning to price what I think is going to be a stagflationary impulse manifested very soon. But I still think we're expensive. I mean, when you look at where the S&P was trading before the Iran situation, we were trading at 22.2 forward earnings. I took a look, Romaine, at the past several oil shocks over the recent decades, and that is 80% above the 12.4 times median at the onset of every major oil shock since 1980. After 4 weeks of selling, it now sits a little lower, 20.3%, but the 10-year average is 18.9, so we're still expensive.
We are expensive, and I also just want to point out for our readers and for our viewers too that we had actually seen some increases in energy prices prior to the actual war starting, and I think people forget that as well. We had started to see a creep up in oil, we had started to see a creep up in fuel prices, but there's another component to this that a lot of people have talked about. The idea, there's a lot of other things that come out of the Persian Gulf. Obviously a lot of chemicals that are used to fertilize our crops and plants in what is supposed to be a very critical spring planting season, aluminum and other metals and other commodities as well. Do we have any sense here as to whether we should now prepare ourselves for additional strain outside of just oil and gas?
You teed me up nicely, Romaine. Everyone's watching Brent at 107. I'm watching Uri at $665 a ton. It's up 40% since February 27th. And we at StoneX, we have a huge commodities component of our firm, but we called this on day 4. So on March 3rd, we said, guys, the sleeper risk here is fertilizer. It's not a fun or sexy topic to talk about, but fertilizer has a calendar constraint that oil does not. The Northern Hemisphere planting window opens in about 4 weeks. It's not something you can delay. It's either you plant or you don't plant. So if this obstruction of the strait, through which 30% of fertilizer, seaborne fertilizer passes, if it goes beyond the planting season, it's a lost season. You can't plant corn in June and expect to harvest in August or September. So I did some work on this. What does this tell us? So yeah, everyone cares about oil and gas at the pump. I care too. But food at home inflation impact, that could be big. We could be talking 2 percentage points for the U.S. We could be talking 4 to 8 percentage points in the most vulnerable regions like Africa, which is very vulnerable. So I think, there are some really important things to consider here. And, food outside of the home does go into core PCE. Right. And consumer inflation expectations matter as well. So I think this is going to change also the trajectory of the Fed.
Absolutely. So, I mean, fertilizer, not sexy, but important. And you lay out very neatly why. I'm wondering, what that means for portfolio implications. How do you invest around that idea? You mentioned the Fed, for example, are ways into it. But is there a more direct way to reflect some of those risks when you're shaping your portfolio?
Yeah, I think, we've had this 15-year trajectory of U.S. exceptionalism. It still remains intact, but I think that the past 1 year that we've seen of international stocks outperforming U.S., I think that's the beginning of something structural. So what I'm telling our people and our clients is to overweight commodity exporters within emerging markets, specifically Brazil and Argentina, go long international over U.S., long gold, hold on to gold, quality credit over high beta, and use any near-term dollar strength as a better entry point into international. So I think that we're going to see some weakness on the margins here. I think valuation has not mattered for 3 years, but in a world where the Fed cannot cut and God forbid has to hike or thinks about hiking, which they are thinking about hiking, then I think earning estimates come down. And that's the only thing that matters.
And I do want to talk a little bit more directly about oil here because, of course, we just heard from the president some additional comments from President Trump saying, I thought oil prices would go higher after strikes. Also that I expected worse. Again, that is President Trump talking about the reaction in oil markets to, of course, the actions in Iran. Do you agree with that? Or, what you're seeing in oil, where does it stack relatively to the scale of what we see unfolding in the Middle East?
Well, it certainly always could have been worse, I suppose. I mean, we're at 107 on Brent right now. It could go higher. It probably will go higher if the Strait of Hormuz doesn't reopen. Natasha Kaneva at JP Morgan did this excellent exercise, so I'm going to quote her, but she counted the days. So every GCC country has a storage capacity limit. So once you meet your storage capacity, you can no longer produce. And that limit is approximately, let's call it on average, about 28 days. We're coming up on that now. So certain GCC countries have already hit storage capacity. They're going to reduce their production. So for every 1 million barrels per day reduction production, it can add $4 onto oil prices. So the longer this goes on, the higher oil prices can rise.
I do want to talk about a little bit more, Kathryn, about kind of the interplay of what is now dollar strength coming off of what had been for the last few years a story of dollar weakness. So the dollar basically rallying against every major currency out there, if you will, most notably the franc, the yen today, the Swedish krona, the New Zealand dollar, and we're not even getting into some of the emerging market assets. You said that it could potentially be the benefit for non-U.S. assets, correct?
Yeah, I mean, I think that if you have a stronger, if you have a scenario where Brazil and Argentina are net crude exporters, and you want to overweight commodity exporters over importers, this is a good opportunity for you to do so. And I think that EM has still a ways to catch up. So for sure, I think there's opportunities internationally. I mean, Japan's certainly expensive. Europe still could go a little ways more, but I specifically like emerging markets and especially those commodity exporters.
All right, Kathryn, always appreciate your insights. Kathryn Rooney Vera.
My pleasure. Thanks, Romaine.
Chief Market Strategist over at StoneX.